Evening, everyone. Very good to be here. Hope you can hear me at the back. When I told my CEO that I'd been trusted to manage this panel, he actually took me aside and offered me a bit of advice. He said, whatever you do, don't try and be funny and don't be intellectual, just be yourself. So anyone seen the pile of paper by the exit, yes, that is my CV, and do feel free to pick one up on the way out. So I guess, as is good in any panel, introducing the panel itself is a good way to go. So I've taken the start in a good way to begin with. So we've got Lois Ollerenshaw. Lois is a principal at the Nationwide Building Society's Corporate Venture Fund. Lois is also the founder of a podcast called Associated, which aims to broaden access to the venture capital industry. It's well worth a listen if you haven't subscribed already. We've got Zoe Peden, who after a decade as an impact tech entrepreneur, decided to take a seat on the other side of the table and become an impact investor. She now runs the London office of the European impact tech VC Ananda, which focuses on late seed and Series A investments. Third down is Ali Morrow, a principal at Astanor Ventures, a specialist venture capital firm investing in wherever tech meets nature. Ali is also a mentor with Rockstart, a Copenhagen and Amsterdam-based VC fund and accelerator. And last but not least, sorry Akash, Akash is an investor at the CAS Entrepreneurship Fund, a micro VC investing in early stage businesses. He is also involved with Shaper Impact Capital, a global not-for-profit network supporting impact startups with their fundraising efforts. And a bit on myself, as you can tell, I quite enjoy talking, that's probably why I was the moderator. But I'm in charge of investor relations at ClearlySo, Europe's leading impact-focused investment bank. And tonight's a bit of a first for me because I've got 4 investors who can't escape my questions. So I'm feeling very excited. I think to begin, to kick things off, I want to ask each of the panel to give their view on what impact investment really means. I don't think that any of us here would contest that the phenomenon of impact investing is quickly becoming the mainstream. However, I expect that we will be far less unanimous in our understanding of its definition. And how better to explore this point than via the panel itself. So, Zoe, you drew the shortest straw in the room earlier. Could you maybe kick us off?
Okay, so this is Ananda's view of impact investment. So it's about backing really mission-driven entrepreneurs, helping them build a global company that changes society for the better or the planet for better, and returning a commercial level return to our investors. So.
Thanks, Zoe. And I think we might go down the line. That's what I said you'd be third, but chaos already.
Yeah, I think it's really important to just admit that impact investment doesn't necessarily have one definition. And so often when people talk about it, you can end up talking at cross purposes because you're talking about completely different things. For Nationwide, which is the organisation that I work for, impact investing is really around the social good that you can have from supporting ventures that have that kind of mission-driven lens.
Interestingly, I think we're all quite different. We're exclusively focused on agriculture and food, so new technology in that space. So we look to create positive change in the food and ag system via new technologies. That's what we mean by impact. We look for venture-style returns. And likewise, we look for IP in the tech we invest in.
So I think this conversation has gotten very topical, obviously, in the last 2 years. A lot of terms get lumped into the impact investing debate. I think it's important to disentangle that. So I think in the public markets, you have ESG funds like BlackRock, Vanguard, that offer sustainable environmental, social governance criteria being taken into the decision-making process. But those companies' primary business activity doesn't actually generate a social or environmental impact. Impact investing, at least I don't speak on behalf of my fund, but is where the primary business activity generates a social or environmental impact. So in the private markets, you have Airbnb who are coming to an IPO very soon, who are touting their stakeholder capitalism credentials recently. Because it's very, it's got a nice halo effect. If you say that you take care of your employees, you take care of the communities, but actually that's not an impact company. No one would say Airbnb is an impact company. But it's because it's very topical now to say that you're sustainable and that you're ethical, that everyone's kind of jumping on the bandwagon. So it's a difference of degree, not of kind, that these companies are on the ESG side where they're making their supply chains more ethical, they're working more with their stakeholders, but impact investing is investing in companies where their primary business activity generates a social or environmental impact.
Perfect, thank you. So I think it's clear that there is some disparity or nuance with how we view impact investing. So to level the playing field, and rightly or wrongly taking the GIN definition of impact investment, which I quote, is an investment made with the intention to generate positive and measurable impact alongside a financial return. Could I ask the panel to raise their hand if they've reviewed a so-called impact investment with a view to investing in it? Okay, and this is where the magic happens. Do keep that hand raised if you went ahead through to completion with that impact investment. All right. So Zoe, I did check out your portfolio beforehand, not to be too creepy, but there was one deal that stuck out for me, which is ISO. Exactly. Good branding there. So as the UK's largest provider of online mental health care, the impact is fairly as obvious, but I would like you to maybe elaborate on any kind of key learnings or interesting insights that the audience might not otherwise know.
So ISO actually in 2019 got referred 30,000 patients. It's been around for 10 years, and when it started out, it was a service-based business. I think it's in 30 or 40.
Vision-oriented thing, but if you change that supply chain whole scale, the impact on the industry is tremendous. And so I think we think about our investment thesis and our impact thesis as one and the same. If you have a coherent understanding of the change you're trying to create, and it's an investable product, namely it's a commercial organization with a business plan that's intelligent, and the technology has efficacy behind it, surely that should give you the results you want, is our view of that world.
Okay, so going back to the earlier questions, Akash, you didn't raise your hand. I'm not going to let the crowd turn on you. I'm not going to ask you why you didn't invest in that impact opportunity, but shame on you, sir. No, but there are obvious challenges associated to impact investment. Keen to hear your thoughts on what you think the greatest challenges are that are facing the sector.
Yeah, I think there are some extrinsic challenges, so perceptional challenges. I think it's no mystery that the venture capital industry is very homogenous. You have mostly white male, elite, educational, socioeconomically privileged people who make up about 80% of the industries. You could give it a different number. It's changing slowly, but it's a fact that these people have biases. These people have ingrained networks. And when a founder comes in and they say we're targeting this underserved market or underserved demographic that these people have no empathy with, they've never come across these people, it's harder for them to see the market. It's just that if we're idealistic about it and we think that venture capital is a proxy for the innovation that we value in society, then that's clearly not what's actually happening, because you have enterprise software, capital light, metric heavy companies that are getting most of the venture funding. If you see the kind of feeds on Bohurst that you see which companies get funded every day, those are the companies that do really well. But I think it's when the investment teams start to reflect the wider demographics of the population, you're going to start to see investors who are more empathetic to companies that are backing, that are trying to solve problems for the rest of the pyramid, and not the 1%, the 1% who have purchasing power, who are already kind of Silicon Valley, Ubers and Instagrams and so forth. So that's one issue, I think, the empathy piece and the kind of not appreciating how you can monetize those demographics. The second is in clean tech. I think generally, these breakthrough innovations in clean tech require some R&D upfront. So maybe first 2-3 years, you need to do some really capital-intensive R&D. I don't think that early stage funds are. It's not that they're not designed to do that, but they won't be. They're always thinking about, even though they won't say it, they are thinking, if I invest in this company now and they need 2 more years of R&D, that's going to be, then they'll go into market in maybe 3 years, and then it's another 3-4 years until I exit. So they are thinking about, obviously, the constraints that they have, and that influences their thinking, that influences how many companies get funded for that R&D, which is very difficult to bootstrap. It's a huge expense. Grant funding can, kind of fill that gap only to a certain degree, but it's not going to fill it completely. And there needs to be, I think one thing which is a positive, which hopefully will change soon, is that pension funds will start to become bigger limited partners. And this is speculation, but in the US this is definitely the case, but in Europe they still represent a very small proportion of the LPs that VCs have. When the rules change, so there are some rules that the Department of Work and Pensions have set that said what percentage of fees can be charged of pension funds. When those rules change and you have more pension funds as LPs, you might have more patient LPs. And when that happens, you may see some of these venture funds investing earlier, where there is maybe a year or 2 of R&D required before that company can commercialize, go to market, and another 3 years before they exit. This is all very hypothetical, but I think there is a problem there in that early 2-3 years of that company's life, where they're not going to be able to have any traction. The investors not going to be able to go to their LP meetings and say, these companies have raised another round, and therefore, we're doing well here. So that's an issue there. But those are things which I think are changing slowly. Yeah, those are my thoughts.
That's a good full answer. Looking forward to seeing the highlight of that one. Lois, when we were speaking earlier, you mentioned a couple of challenges that you think are kind of prevalent in the space. Maybe kind of giving a specific example as well would be helpful for everyone to hear about.
Yeah, I think to build on the first point that Akash made, there's definitely a point around how homogenous the VC community is. But I personally see that changing a lot, and I think there are lots and lots of options for funding, for not just impact ventures, but any kind of ventures now. And for me, I think the challenge, but also the opportunity, is finding the right one. So find the investor where your incentives are aligned, and there are, we're 4 different ones represented here. There are infinite others. For Nationwide, we're a strategic investor, so we're a corporate and we'll help to scale, and we want to work together with our portfolio companies. For some people that's the right option, for some people it's not. But I think particularly with impact, it's so important to make sure your incentives are aligned, and particularly when they revolve around things that kind of surpass revenue and exits and returns. It's really important to make sure that happens.
Yeah, I was just thinking about everything that everyone's saying, and there are more and more impact funds coming through. Big Society Capital are one of our LPs, so we're one of their reference calls as well. So I get to hear about all the funds that are coming through, before they come through, and there's quite a few. So it's good. You can, it's exciting out there. You can feel the landscape changing. So there are still gaps in funding. There needs to be different types of funding, from, like the talk before, from equity and debt. But we're starting to see different funds coming through. I mean, Ananda's fund's getting bigger and bigger as we grow. And fantastic, some might say, but bad in other ways, because the bigger it grows, it cuts out certain things that we can't invest in anymore because the total addressable market isn't big enough for the returns that we need to make. But that usher in smaller funds that are coming with 20 to 30 million or even 10 million. Fantastic, because they can back those ones. Whereas now, as our fund gets bigger, we need to be looking at the ones that are at least 100 million, 200 million returns. So it's moving, it's shifting, isn't it?
Thanks. So on that positive note, and it is a Thursday evening, so we might as well try and get a bit cheery. I think there are lots of good things to be shouting about the space. Ali, kind of going against the vein of maybe kind of the challenges, are there any other kind of positives that you think are really hitting the space? Fantastic.
Again, I think we are particular to our sector, so the opportunities that we look for and what we get excited about are predominantly, I guess, a couple of things. There's much more of agri-food tech was not a word that I could sort of say publicly without mockery or otherwise 4 years ago. I think it's now understood in a way. There's people understand what you're looking for and what you're thinking about. In our world, there's much conversation around regenerative agriculture, which circular economy is sort of the broader remit. Regenerative agriculture is bespoke to our system, and one that understands soil health as paramount to that. If you think of soil as your canvas, if you don't rehabilitate that, you have nothing, and if we don't have food, that's a slight problem with respect to the human population, among many others, but arguably one of the most important. Same story with water, which is the world's lungs. It's where we get most of our oxygen. So I think the recognition of those as massive pain points, instead of when this space started, it was food tech rather, and that was much more of a superfluous space. There's nothing wrong with just eat and deliver and otherwise, but when we're talking about systemic change, arguably, rapid fire pizzas is